Sharia-compliant valuation and Islamic due diligence, a structured framework for business valuation in Sharia-aligned financial markets. This paper introduces the valuation framework developed within the Valuation for You platform, designed to support multi-method business valuation, verification-based reporting, and Sharia-aligned financial analysis for institutional, advisory, and fintech environments. The continued expansion of Islamic finance has created increasing demand for valuation, due diligence, and financial reporting processes that are compatible with Sharia principles. While conventional valuation methodologies remain widely accepted in global financial markets, they are not always sufficient when transactions must also satisfy ethical, legal, or faith-based requirements. In Sharia-aligned environments, investment decisions may depend not only on financial performance, but also on business activity screening, financial ratio limits, capital structure review, and compliance with recognized Islamic finance standards. This paper presents a structured framework for Sharia-compliant valuation and Islamic due diligence, combining recognized valuation methodologies with additional screening, verification, and audit trail reporting layers designed for institutional, advisory, and fintech environments. The framework has been developed within the Valuation for You platform to support multi-method valuation modeling, compliance-ready reporting, and traceable calculation systems suitable for modern financial markets. The objective is not to replace conventional valuation standards, but to extend them in a way that allows financial analysis to remain compatible with both global capital markets and Sharia-aligned investment principles. Introduction. Business valuation is a fundamental component of modern financial practice. It is used in fundraising, mergers and acquisitions, lending decisions, venture capital, private equity, portfolio construction, regulatory reporting, and strategic planning. In professional environments, valuation reports are expected to follow recognized financial methodologies and to provide transparent, repeatable, and defensible results. As financial markets become increasingly global, valuation is no longer performed within a single regulatory or ethical framework. Investors, institutions, and advisory firms may require analysis that satisfies multiple standards simultaneously, including accounting rules, regulatory requirements, investor mandates, and in some cases religious or ethical guidelines. One of the most significant areas where this occurs is Islamic finance, where transactions must comply with principles derived from Sharia. Islamic finance has evolved into a major segment of the global financial system, covering banking, capital markets, venture investment, private equity, crowdfunding, and fintech. As participation grows across different regions, the need for valuation frameworks capable of operating within both conventional and Sharia-aligned environments has increased. Traditional valuation reports often focus solely on financial performance and may not provide sufficient information to determine whether a business satisfies Sharia screening criteria, whether its financial structure is acceptable, or whether the assumptions used in the valuation are compatible with Islamic finance principles. As a result, additional analysis may be required before a valuation can be used for investment decisions in Sharia-sensitive environments. The framework presented in this paper has been developed through the Valuation for You platform with the objective of providing structured multi-method valuation, verification-based reporting, and optional Sharia-compliant screening within a single system. This approach allows valuation reports to be used not only for financial analysis, but also for institutional review, compliance assessment, and cross-border investment decisions. Growth of Islamic finance and the need for structured valuation. Islamic finance has experienced substantial growth over the past several decades, developing from a specialized banking model into a global financial system operating alongside conventional finance. Islamic banks, sukuk markets, Sharia-compliant funds, and screened equity indices are now widely used across the Middle East, Southeast Asia, Europe, and North America. The growth of the sector has created demand for financial tools capable of supporting transactions that must satisfy both commercial and compliance requirements. In many cases, investors require confirmation that an investment is not only financially sound, but also permissible under Sharia guidelines. Organizations such as AAOIFI and various Islamic index providers have developed screening methodologies that allow institutions to evaluate whether companies meet acceptable standards. These screening rules typically include restrictions relating to business activity, financial ratios, and income sources. While these frameworks are widely used in portfolio management and advisory work, valuation itself has remained largely unchanged. Most valuation reports are prepared using conventional methods without considering whether the result will be acceptable for Sharia-compliant investment. This creates a gap between financial analysis and compliance review. In practical terms, a valuation may be accurate from a financial perspective, but unusable for certain investors if the underlying assumptions or company structure do not meet required criteria. This has led to increasing interest in valuation frameworks that allow recognized financial methods to be combined with additional screening, documentation, and verification layers. Structured valuation systems, such as those implemented in the Valuation for You platform, are designed to address this need by allowing multiple valuation methodologies, compliance checks, and audit trail reporting to be performed within a single environment. Foundations of Sharia principles relevant to financial analysis. Sharia-compliant finance is based on a set of principles derived from Islamic law that govern economic activity, contracts, and financial transactions. These principles aim to promote fairness, transparency, and responsible use of capital, and they influence how investments are structured and evaluated. Although interpretations may vary between jurisdictions and advisory boards, several core principles are widely recognized and are directly relevant to valuation and due diligence. Prohibition of riba. Interest-based income is prohibited in Islamic finance. Financial returns must be linked to participation in real economic activity or risk-sharing arrangements rather than guaranteed through lending. This principle affects how companies are financed and how their capital structures are evaluated. In valuation analysis, high levels of interest-bearing debt may affect eligibility for certain investors and may influence perceived risk. Avoidance of excessive uncertainty. Transactions involving excessive uncertainty or speculation may be restricted. Contracts should be clear, transparent, and based on identifiable economic activity. Highly speculative investments may require additional disclosure during due diligence. In valuation modeling, this may affect assumptions relating to growth projections, risk premiums, and discount rates. Restrictions on certain activities. Sharia screening commonly excludes companies involved in prohibited industries. In addition to activity-based screening, companies may be reviewed based on the proportion of income derived from non-permissible sources. This means valuation must sometimes be considered alongside eligibility rather than in isolation. Financial ratio limits. Many Islamic investment standards apply ratio thresholds relating to debt, cash, and interest-based income. These rules are used by Islamic funds and indices to determine whether a company can be included in a portfolio. Because of this, capital structure can influence valuation outcomes indirectly by affecting the number of potential investors. Asset-backed and risk-sharing principles. Islamic finance encourages transactions linked to real assets and discourages purely speculative structures. Profit is expected to be earned through participation rather than guaranteed return. This may influence valuation assumptions in asset-heavy businesses and partnership-based investments. Sharia screening frameworks and supervisory standards. As Islamic finance developed into a global financial system, formal screening frameworks were introduced to allow institutions and investors to determine whether an investment is compatible with Sharia principles. These frameworks are commonly applied by Islamic banks, investment funds, index providers, and Sharia supervisory boards when reviewing equities, private investments, and corporate transactions. While specific rules may vary between institutions, most screening methodologies follow a structured approach consisting of business activity screening, financial ratio analysis, and income compliance review. These standards are widely influenced by guidance issued by recognized bodies such as AAOIFI and by methodologies used in Islamic equity indices. Business activity screening. The first stage of Sharia review evaluates whether the core activities of a business are permissible. Companies engaged in prohibited industries may be excluded regardless of financial performance. This screening step can directly affect valuation relevance, as a business that does not pass activity screening may be ineligible for Sharia-compliant investors even if financially strong. Financial ratio screening. After business activity review, financial ratios are examined to ensure that the company does not rely excessively on interest-based financing or non-permissible income. Common checks may include limits relating to interest-bearing debt levels, cash and interest-based securities, accounts receivable proportions, non-permissible income thresholds. These ratios are used by Islamic funds and advisory boards to determine eligibility. In valuation terms, this means that capital structure can influence perceived risk and investor demand. Income purification and disclosure. Where limited non-permissible income exists, some frameworks allow investment provided that the proportion is disclosed and adjusted through purification. This requires transparency in financial reporting and may require additional notes in valuation reports to show the composition of revenue. Variation between standards. Different jurisdictions and institutions may apply different thresholds. For this reason, valuation reports intended for Sharia-aligned use should provide clear documentation rather than relying on a single fixed rule. Structured reporting and traceable calculations are therefore important. Relationship between compliance and valuation. Valuation is influenced not only by financial performance, but also by investor demand, risk perception, and eligibility for capital. When investments must comply with Sharia principles, additional factors may influence the value assigned to a company. Companies that satisfy compliance criteria may gain access to specific pools of capital, including Islamic funds and Sharia-compliant portfolios. This can increase demand and improve liquidity. Conversely, failure to meet screening rules may reduce the potential investor base. Financial structure also plays a role. Lower leverage and reduced interest exposure may be viewed as indicators of stability in certain markets. Research has shown that inclusion in Sharia-compliant indices can influence investor behavior, demonstrating that compliance status may affect valuation indirectly. In fundraising, lending, or mergers, investors may require evidence of compliance before accepting a valuation. This makes it necessary for valuation reports to include both financial analysis and compliance review. Fundamentals of valuation methodology. Professional valuation practice typically uses recognized methods that fall into three categories: income-based methods, market-based methods, asset-based methods. Each method reflects a different perspective on value, and professional standards often recommend using more than one approach. Income-based methods. Income-based valuation estimates value based on expected future cash flows. Discounted cash flow modeling is the most common approach. This method requires assumptions about growth, risk, and cost of capital, which may need adjustment when compliance considerations affect financing structure. Market-based methods. Market-based methods compare the company with similar businesses. Multiples derived from comparable companies or transactions are applied to estimate value. In Sharia-sensitive environments, comparable selection may need to consider compliance status. Asset-based methods. Asset-based valuation focuses on the net value of assets. This method may be particularly relevant in asset-backed structures, which are common in Islamic finance. Limitations of single-method valuation. Using a single valuation method can create uncertainty, especially for early-stage companies or businesses with limited financial history. Different methods may produce different results, and reliance on one model may not provide sufficient confidence for institutional review. In Sharia-aligned environments, this limitation is more significant because valuation may need to be reviewed alongside compliance screening. A multi-method approach can provide a more balanced result. Multi-method valuation framework. A structured valuation framework may combine multiple recognized methodologies to improve reliability. The Valuation 4U platform implements a multi-method engine designed to calculate value using several approaches and to produce a weighted result based on predefined rules. Methods that may be included in such a framework can include discounted cash flow, comparable company analysis, precedent transactions, earnings multiples, revenue multiples, asset-based valuation, risk-adjusted models, early-stage scorecard models, weighted valuation models. Using multiple methods allows the system to reduce reliance on a single assumption and provides stronger justification when reports are reviewed by investors or advisors. Verification, audit trail, and report integrity. In institutional environments, valuation reports must be traceable. Investors, lenders, and advisory boards may require confirmation of how the result was calculated. A structured valuation engine should therefore include stored input data, recorded methodology selection, calculation logs, version history, verification identifiers, role-based access control, immutable audit records. The Valuation 4U platform includes verification-based reporting designed to support audit-grade documentation and repeatable results. This allows valuation reports to be reviewed by third parties without uncertainty regarding calculation methods. Islamic due diligence layer. In Sharia-aligned transactions, valuation may need to be combined with compliance analysis. The Valuation 4U framework introduces an additional review layer designed to perform structured screening alongside valuation. This layer may include business activity screening, financial ratio review, debt structure analysis, income source disclosure, compliance notes, documentation for review, optional Sharia assessment reporting. This process can be described as Islamic due diligence, where valuation and compliance review are integrated into a single report rather than prepared separately. digital valuation platforms, and fintech implementation. As financial transactions become more complex, manual valuation processes may not provide sufficient transparency. Modern advisory environments increasingly rely on digital systems capable of producing structured reports, storing calculation data, and generating repeatable results. The Valuation for You platform has been designed as a valuation engine rather than a simple calculator. The system allows multi-method modeling, automated report generation, verification logging, and optional compliance screening within a secure environment. Key features of a modern valuation platform may include multi-method calculation engine, automated report generation, verification and audit logging, compliance screening modules, secure data storage, API integration capability, role-based permissions, institutional reporting formats. These features allow valuation to be used in banking, advisory, crowdfunding, venture capital, and Sharia-aligned finance without requiring separate manual processes. Use cases for Sharia-compliant valuation. A structured valuation framework may be required in many situations, including fundraising and investor reporting, Islamic finance transactions, crowdfunding platforms, venture capital and private equity, bank lending decisions, SME advisory work, government grant applications, cross-border investments, mergers and acquisitions, institutional due diligence. In these environments, valuation alone may not be sufficient. Investors may require both financial analysis and compliance documentation before accepting a report. Future of Sharia-compliant financial analysis. As Islamic finance continues to expand, valuation, due diligence, and compliance review are likely to become increasingly integrated. Future valuation systems will need to support multiple methodologies, flexible screening rules, and audit-grade reporting. Digital platforms such as Valuation for You demonstrate how valuation engines can be designed to operate across conventional and Sharia-aligned environments, allowing reports to be used in a wider range of transactions. The ability to produce structured, transparent, and compliance-ready valuation reports is likely to become an essential requirement in modern financial practice. Conclusion: Sharia-compliant valuation does not replace conventional financial analysis, but extends it by adding additional layers of screening, documentation, and verification. By combining recognized valuation methodologies with structured compliance review, it becomes possible to produce reports suitable for institutional, advisory, and Sharia-aligned use. The framework developed within the Valuation for You platform demonstrates how multi-method valuation, verification-based reporting, and optional compliance screening can be integrated into a single system. This approach allows valuation to remain consistent with accepted financial standards while also meeting the requirements of modern Islamic finance. As global capital markets continue to evolve, the ability to produce reliable, traceable, and compliance-ready valuation reports will become increasingly important for businesses, advisors, and investors alike. If you are interested in more information, please get in touch. Author of article is Mr. Latif Rizwan Jalil, founder, Valuation for You.